Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the complex language of big business. And today we have a massive filing from the Exchange Place Advisors Trust, a veritable mountain of financial information that on the surface looks like a dry report. But trust me to rehear about a company navigating some big changes, and the numbers might surprise you before we dive in if you like getting these. Deep dives into corporate filings without all the jargon, make sure you hit that subscribe button and check out our Discord server linked in the description. We have a great community there hanging out and discussing these things. Alright, so what we have here is a certified shareholder report from the Exchange Place Advisors Trust. Think of this as a regular checkup for a bunch of investment funds. They have to tell the SEC, the Securities and Exchange Commission, all the important stuff happening with their money, their investments, and how they are doing. It's mandated reporting, so it's not exactly exciting reading, but it gives us a peek behind the curtain. The reporting period we are looking at is ending the 30th of November 2025. Now, this report covers several different investment funds, all operating under the umbrella of the Exchange Place Advisors Trust. They are essentially different investment portfolios or buckets of money managed by the same overall entity. The filing is quite extensive because it details the situation for each of these funds. The very first thing that stands out is that this is not just one company, but a trust managing multiple funds. This is common in the investment world, often called a unit investment trust or UIT. They are reporting their financial health and activities as required by law. Now let's get to the meat of it, the financials. When we look at the cost for a hypothetical $10,000 investment for the Class I shares of the North Square Small Cap Value fund, we see the cost was $60, which is 1.11% of the investment. For the investor class shares of the same fund, the costs were $73, or 1.36%. This gives us a quick idea of how much it costs to have your money managed in these funds. It's important to note that these are just the costs for that 6-month period and can vary. Let's look at some key numbers for the North Square Small Cap Value Fund. The net assets are listed as $180,115,019. That sounds like a lot of money, and it is, but it tells us the total value of all the investments within that particular fund. Then we see the number of portfolio holdings, which is 75. That means the fund is invested in 75 different companies or assets. They also report an advisory fee of $754,804. This is the fee paid to the company managing the fund. Portfolio turnover is at 24%. Portfolio turnover is basically a measure of how often the fund buys and sells its investments. A lower turnover rate, like 24%, might suggest a more buy. And hold strategy. And what are they actually invested in? The top 10 holdings are listed, and the largest is Whitecap Resources Incorporated at 2.6% of net assets. Hancock Whitney Incorporated follows at 2.4%. This is crucial because it shows where the fund managers are putting their money. When a large portion of the fund's value is tied up in just a few companies, any issues with those companies can really impact the fund's performance. It is a good sanity check to see if the fund is diversified or heavily concentrated. Now, let's look at where the money is invested by sector. The financial sector is the largest at 19.7%, then industrials at 19.3%. This tells us that the fund is heavily invested in companies that service businesses and banks. Technology is also a significant chunk at 13.3%. This breakdown is really important because it shows the fund's exposure to different parts of the economy. If one of these sectors faces a downturn, it could significantly affect the fund. Okay, this next part is juicy, and it explains a big change that happened around the 8th of January 2026. Azimut Group, an Italian asset management company, bought the company that manages these funds. This is a big deal, and it means a change in ownership. The report assures us that day-to-day management isn't expected to change dramatically. Investment goals should stay the same. But even with these assurances, this kind of acquisition always brings questions about how things might shift. It also means that the advisory agreements had to be reapproved because a change in control basically counts as an assignment under the law. This usually triggers a termination of the old agreements and a need for new ones. So the big news is this acquisition by Azimut Group and its US subsidiary Azimut US Holdings Incorporated. This is a pretty significant move. It happened around January 2026. They acquired the entity that manages these investment funds. The report tries to calm nerves by saying business as usual will continue. Investments, objectives, and strategies are expected to remain the same. But what's interesting is that even though they say things will stay the same, the acquisition itself triggered a legal assignment of the existing advisory agreements. This means the old contracts were automatically terminated and new ones had to be put in place. This is a common occurrence after a change in control, and it is a legal formality to ensure everything is above board. Following this acquisition, shareholders had to vote on new advisory agreements. This happened in December 2025. It seems there was a delay as the meeting was adjourned a couple of times. Ultimately, shareholders approved the new agreements. This is a critical step to ensure the funds continue to operate smoothly under the new ownership. The report highlights that shareholder approval wasn't needed for the sub-advisory agreement because of something called Manager's Exemptive Relief. This basically means a special permission from the CC allows them to streamline that part of the process. Now it's time for my 2 cents on what this all means. On the surface, these reports can look like a lot of dry numbers and legal speak. But the core story here is a change in ownership for the management company. They are trying to reassure investors that it's business as usual, but acquisitions almost always bring some level of risk and uncertainty. The financials themselves paint a picture of diversified portfolios with significant holdings in sectors like financials and industrials. The cost percentages for investors are reported, which is helpful for anyone considering these funds. One thing to watch is the impact of Azimut Group as the new owner. Will they bring new strategies or efficiencies? Will there be any subtle shifts in how the funds are managed, even if they say nothing will change? The approval of new advisory agreements is a positive sign for stability. However, the delay in shareholder meetings suggests some complexity or perhaps some investor caution around these changes. The risks disclosed are pretty standard for any investment fund, covering equity risk, preferred securities risk, and even more specific ones like mortgage-backed and asset. Backed securities risk. The fact that they are investing in other funds like ETFs and mutual funds means investors are indirectly exposed to the risks within those underlying investments and also paying double layers of fees. Overall, the company seems to be navigating a period of significant transition. The numbers presented are from late 2025, so we are seeing a snapshot of the funds right before this acquisition was finalized. The key for investors will be to monitor how the new ownership impacts performance and expenses going forward. Alright, that's our deep dive into this complex SEC filing. What are your thoughts on this acquisition and the financial health of these funds? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate insights. And remember to check out the Discord server linked in the description to keep the conversation going. Thanks for watching, and I'll see you in the next episode.